That initial $500 felt like a small fortune when it first sat in the digital wallet, though in the grand scheme of the global markets, it was little more than a drop in a vast, uncaring ocean. The decision to enter this arena arrived at the reckless hour of 11:30 on a Tuesday night, driven by a siren song found on a Reddit thread that boasted of turning $2,000 into $14,000 in just 3 short weeks. At that moment, fundamental metrics like price-to-earnings ratios or market capitalizations were alien concepts. The only thing that mattered was the ticker symbol. Armed with nothing but blind optimism, a purchase of 11 shares was executed. For the next several hours, the screen was refreshed every 4 minutes as if the sheer force of observation could move the needle. When the price ticked up by 3%, it felt like discovering a secret shortcut to wealth, a moment of pure, unearned ego. But the market is a harsh teacher, and by the following morning, the position had plummeted 9%. There was no plan for an exit, only a stubborn refusal to sell and a hollow self-reassurance that a massive comeback was just around the corner. 6 weeks later, that stubbornness resulted in a loss of $190, leading to a quiet retreat where the app was closed, though the hope of a recovery kept it from being deleted. Total silence followed for 3 months until a fundamental question shifted the perspective. It was no longer about which stock to buy, but why stocks existed as a vehicle for wealth at all. After consuming 2 videos and 1 book, the concept of index funds emerged as a revelation. This discovery brought a quiet sense of surprise and a steadiness that replaced the previous frantic energy. It was a transition into what can only be described as the boring feeling of true investing. The new philosophy abandoned the hubris of picking winners or predicting swings in favor of simply owning the market. A real brokerage account was opened, and a commitment was made to automate $200 every month into an S&P 500 ETF. Looking at the math of a 10% average return over 30 years necessitated reading the figures twice just to grasp the scale of compounding. The realization dawned that while most people lack the discipline to stay the course, the very mundanity of the process was its greatest strength. Your mind begins to oscillate between a dangerous sense of arrogance and a sudden, sharp clarity. It is no longer about just finding an edge in the noise. It feels like you have finally discovered the beginning of a grand framework that governs the flow of capital. You look at index funds with a certain disdain, viewing them not as a safe harbor, but as a total surrender to mediocrity. When you close a position for a gain, your hands shake, not out of a lingering fear, but from the raw, electric surge of a win. On green days, you feel chosen, as if the market has reached down to validate your existence. On red days, the world feels fundamentally wrong, every shadow cast in a shade of scarlet. You shield your ego by rebranding every crushing loss as tuition paid to the markets, a necessary cost of a high-level education. You track your profit and loss with a disturbing, surgical precision, knowing exactly where you stand at every moment of the trading day. The numbers start to tell a dramatic story. You experience the high of making $800 in a single morning on a biotech catalyst, followed by a steady $200 the next week. But the market is a cruel teacher. 2 months after that initial rush, you find yourself down $11,000 on the year. You fight back, capturing a 40% gain in a single month after stalking a volatility play for 6 weeks. Yet, that entire gain vanishes in just 8 days when the hedge you built becomes the source of your ruin. Then, you discover options. Within 3 weeks, you are fluent in the language of delta, gamma, theta decay, and implied volatility. You stop seeing trades as bets and start seeing them as leverage with geometry, complex architectural structures built on time and price. This newfound confidence leads you to dump $6,000 into call options the day before an earnings report. In 48 hours, that $6,000 collapses to a mere $340 because the stock moved in the wrong direction. You return to the study of the Greeks with the desperate, white-knuckled focus of someone who has recently been shown exactly what the floor looks like. As you migrate into the second phase, the transformation becomes both intellectual and behavioral. The frantic urge to check the market screen every 4 minutes evaporates, replaced by a disciplined stillness. You find yourself hunched over the classics, underlining passages in The Intelligent Investor 3 times until the ink bleeds through. You absorb the wisdom of Poor Charlie's Almanac, which instills an unusual, quiet composure. By the time you have finished reading every single Warren Buffett shareholder letter from 1965 to the present, a singular insight takes hold. Simplicity is not an absence of effort, but the refined output of extraordinary depth. This realization leads to a radical pruning of your holdings until only 8 positions remain. You demand a complete understanding of the business, durable competitive advantages, and honest management. The ultimate metric of conviction arrives when you hold through a 22% drawdown without flinching. You stop watching CNBC entirely, not out of a forced sense of discipline, but because the noise is no longer relevant to your timeline. While the rest of the world obsessively parses the Federal Reserve's next quarter, you are looking at where a company will stand in 12 years. This distance from the herd is quiet and real, leaving one to wonder if such a gap in perspective is a rare gift or a heavy cost of the trade. The professional transition begins when the requests to manage external capital start arriving. After a long period of internal deliberation, you finally say yes and file the paperwork. You launch with 40 limited partners and $28 million in assets under management, but the milestone brings a new, permanent weight. This isn't exactly fear. It is a gravity that persists long after you close your laptop. You understand with absolute clarity that the stakes have changed. A single bad year can incinerate the fund, the relationships, and the trust built over a lifetime. Consequently, you begin investing more honestly rather than merely more cautiously. You filter every move through a simple lens. Can this be defended at length to a partner who trusts me? This filter immediately strips away the low-conviction ideas you once acted upon, forcing you to stop confusing frantic activity with actual performance. The result of this ruthless selection is your best year yet, a return of 31%. You stay. You grow. In the high-stakes world of finance, business satisfaction is ultimately measured by retention and the steady compounding of growth. There is a difference so profound it can take a decade to fully feel it, a shift that often begins quietly at a conference table. Imagine sitting across from the chief investment officer of a university endowment, absorbing their logic. A year later, you are that person. You find yourself overseeing for $1 billion, yet the nature of the work has fundamentally transformed. You are no longer the one picking individual stocks in the trenches. Instead, you are the architect allocating capital to managers. In this rarefied air, the evaluation criteria shift entirely, placing the integrity of the process far above the volatility of immediate results. At the bottom level, the game is a hall of mirrors where everything is filtered through surface perceptions. To the uninitiated, investing looks like money, specifically the kind of fast, obvious wealth flaunted across social media feeds. This is the realm of the novice staring intently at a $500 account on a phone screen, convinced that the only thing standing between them and a fortune is finding the right ticker symbol. They treat the stock market like a shortcut to a destination they haven't earned, searching for a magic sequence of letters, as if they were hunting for a winning lottery ticket in a gas station bin. But the reality is that the market is never truly about these superficial flashes of green. As one climbs to the middle level, the perspective shifts toward information. Here, the struggle looks like a battle of data. The core logic dictates that whoever possesses the most knowledge inevitably wins. While this is certainly closer to the truth than the delusions of the surface level, it remains a dangerously incomplete picture. It is only at the highest levels that the market stops looking like a market at all and begins to look like philosophy. At this altitude, the technical noise fades, replaced by a brutal interrogation of the self. Success is no longer defined by who trades the most, who identifies the cleanest chart setup, or who catches the largest percentage move. It is not even about who blows up the fewest accounts. Instead, long-term mastery is defined by a profound understanding of the what and why behind every action. The narrative shifts from predicting what the market will do next to questioning what kind of investor a person is actually capable of being. It requires a level of self-honesty that most people spend their entire lives avoiding. You must determine what you truly understand and where your real edge lies, especially when the price action screams that you are wrong while the underlying business fundamentals insist you are right. You must decide what you are willing to hold when every instinct says it is irrational to stay. Ultimately, the market functions like a massive, indifferent machine that runs regardless of individual choices. The true focus is never just picking the right stock, but managing uncertainty, mastering time, and reconciling the ego's desperate desire to be right with the professional's necessity to be honest.